it's important to look over the last 4 to 5 years of what drove very strong equity market returns of 15% plus per year. And that is a combination of, you had the improvement of economies for the most part from the GFC, you had profit margins moving up, PE expansion occurring due to increasing risk appetite, alongside very accommodative monetary policy. The combination of all of those things drove very strong and, in our view, unsustainably strong equity market returns. We now see the environment changing somewhat. Interest rates cannot go any lower, and to a large extent are probably going to increase in US and the UK. Profit margins are at all-time highs. PEs are historically expensive. So all of that leads to the future we think is going to be a lot more challenging. We are seeing opportunity in certain select high-quality industrial names. They are being impacted by slowdown in China, slowdown in emerging markets, strong US dollar. And certain of those companies, when you look through the cycle, are trading at significantly depressed valuations. One such example that we've recently purchased is Precision Cast Parts. It's one of the larger holdings in the fund. They're a large provider of products and equipment to the aeronautical and aerospace industries. This month, Berkshire Hathaway has agreed to buy the company at about a 25% premium to the current price. And that's an example of a long-term investor looking and finding opportunities within this market. For some time, we've quite liked certain companies within the financial sector. We believe that an opportunity presented itself as some of these companies moved through the regulatory and legacy issues that they had. And as that process has occurred, the valuations have been more reflective, and it's actually worked out quite well for us. However, we do believe we're still only in the middle of that game, and the gap between the valuations of those businesses and the rest of the market is still quite significant. Companies like Citigroup, Bank of America, UBS, in our view, present uniquely attractive reward versus risk ratios at the moment. In an environment where equity markets are becoming more challenging, the first port of call for most investors is actually to hide in safety towards whether it's consumer staples or very companies that have stability of earnings and higher dividends. And while intuitively that does make sense, we do think the gap between the valuations of those businesses and the rest of the market is quite significant, and we would actually be quite concerned about certain of those businesses at the moment. Yeah, well, actually, now that the market's become more volatile, we actually find that to be a far more interesting and opportunistic time for our investors. One, there are far more opportunities for long-term investors than there have been over the last couple of years, which is a function of a more volatile market. Secondly, we are a significant beneficiary from volatility and find that we generate better returns and find better opportunities in such environment. So put that together, we're actually quite excited about the time frame we're going into.